When asking questions about corporate governance, executive pay, and the performance of national financial markets, this committee should proceed very cautiously. Shareholders have the most direct stake in these issues. Ours, at best, a derivative and potentially damaging role in the discussion of complex transactions, proprietary business decisions, and marketplace dynamics. The last thing union pension funds and other investors want is Congress second-guessing and micromanaging the people looking after their money. That said, there is no dispute the housing market is undergoing a significant contraction, and many Americans are suffering the combined hardships of foreclosure and depressed home values. Causes of the unfolding credit crisis involve an intricate web of actions, incentives and assumptions by lenders, mortgage brokers, fund managers, credit rating agencies, and many others. In that long chain of causation, the impact of corporate executive compensation is debatable, and that appears at least part of the debate we'll have today. Fine, but that debate should not degenerate into a sanctimonious search for scapegoats. If every corporate executive of every company involved in subprime lending and securities had worked for the minimum wage, or for nothing, the macroeconomic trends and cyclical forces that drive booms and busts could still vex our economy today. Punishing individual corporate executives with public floggings like this may be a politically satisfying ritual, like an island tribe sacrificing a virgin to a grumbling volcano. But in the end, it won't answer the questions that need to be answered about corporate responsibility and economic stability. Boards and shareholders have already begun to answer these questions for themselves. They've taken steps to assign responsibility and hold corporate managers accountable. CEOs have resigned. Potential payouts have been surrendered or reduced, and so-called golden parachutes trimmed. Investor groups are suing to recoup funds, alleging violations of regulatory and fiduciary duties. It is in those forums that the sad story of the subprime industry should be litigated. We should never substitute our judgment for determination by those with real equities at stake, nor should we allow the committee to be used as a discovery tool for plaintiffs. Our previous hearing on executive compensation consultants failed to find much evidence of the claimed conflicts or self-dealing that can distort salary and perk decisions to the detriment of stockholders. Today's attempt to wrap that unproven premise in the much larger subprime crisis only seems to muddle the issue further. Subprime lending expanded mortgage loan availability to underserved groups as Congress mandated. With the encouragement of regulators, innovative financial instruments increase liquidity and spread subprime risks across a broader range of supposedly savvy investors. But almost everyone involved became entranced over time by the unsustainable promise of ever-rising home prices. We've seen this before. When the music stopped and real estate markets fell, foreclosures escalated, and holders of subprime-backed securities lost billions. In that context, the case studies in corporate compensation the committee released yesterday have much more to do with changing market conditions, flawed economic assumptions, and rosy risk assessments than with inappropriate compensation incentives. Remember, when viewed in the rearview mirror, objects are closer than they appear. At our request, one of the witnesses on today's first panel will describe the interrelated functions and dysfunctions in subprime markets. We appreciate his being included in this hearings. Mr. Chairman, if the minority does not have a witness at the table who is an expert on questions of executive compensation, we would like to enter into the record a publication by the Business Roundtable explaining best practices on executive compensation.
Without objection, that will be
Mr. Chairman, I'd also
the record.
like to enter into the record a publication from the Federal Reserve Bank of New York, published in 2000, which praises the securitization of low to moderate income mortgages as a means of increasing the capital available to those communities. I believe it sheds some light on the role of the federal government played in encouraging the securitization of subprime mortgages.
Without objection, that will also be made part of the record.
We may not like it, but markets at times produce inequities, and they correct them. Government involvement in that process generally makes matters worse, not better. A professional baseball player with a $17 million contract who hits only 200 in a season still gets paid. Jennifer Lopez and Ben Affleck didn't have to pay reparations for moviegoers after Giggly. But in both cases, their value in the marketplace returns to equilibrium relative to performance without government intervention. That's the hard lesson underlying all the testimony today, and we look forward to a frank and informative discussion. Thank you, Mr. Chairman.